The disruptions caused by COVID-19 have led to heightened financial stress for borrowers across the board. A large number of firms that otherwise maintain a good track record under existing promoters face the challenge of their debt burden becoming disproportionate relative to their cash flow generation abilities. This can potentially impact their long-term viability and pose significant financial stability risks if it becomes widespread. Accordingly, it has been decided to provide a window under the June 7 Prudential Framework of the Reserve Bank, that is June 7 of 2019. Under that framework, it has been decided to provide a window to enable lenders to implement a resolution plan in respect of eligible corporate exposures without change in ownership, as well as in respect of personal loans.
That was, of course, the big newsmaker of today. That's the RBI Governor Shaktikanta Das after the recently concluded Monetary Policy Committee meeting, wherein the repo rate was held steady at 4%. They noted the short-term inflation outlook, but further, lots of interesting announcements. Firstly, more liquidity for NBFCs and housing finance companies, and secondly, a resolution plan for personal loan borrowers. These are some of the important issues and announcements that will affect people like you and me, and that's what I'll be discussing in the next 1 hour on The Money Show. Hello everyone, a very good evening. I'm Mubina Kapasi, and let's tell you what we have lined up today on the show. First up, before I talk about the nitty-gritties of how the RBI's monetary policy meeting will affect your loans and your deposits, there's something else that it will affect, and that is in your portfolio, the debt funds, fixed income funds. Like we've always been flagging off on The Money Show, as opposed to equity funds, debt funds are still invested in for the relatively shorter term. And that's the reason why it has a macroeconomic link as well. Every change in interest rates, inflation numbers, currency movement does tend to impact the debt funds as well. And remember, again, when I say debt funds, I'm talking about all the different kinds of debt funds, from the short duration funds to the long duration funds, the AAA rated funds, the Gilt rated funds, so on and so forth. It may confuse quite a few of you all, especially because debt funds do tend to carry quite a bit of jargons with them, and that's the reason why we decided to address just that. First up, let me introduce on the show Devang Shah, of Deputy Head of Fixed Income with Axis Mutual Fund. Devang, welcome to The Money Show, and thank you so much for joining us today. So first up, I wanted to get in your sense on how have you read into the central bank announcements. First up, obviously, the interest rate has been put at just 4%, and they've also said that short-term inflation will stay elevated. And like I also flagged off, more liquidity in the system plus a few resolutions. But from a debt fund perspective, how are you reading into India's current macroeconomic environment?
So I think, if you look at the overall aspects on macro, which is growth and inflation both, probably the pandemic, the COVID-19 pandemic has delayed the recovery for the growth cycle in India. Now, when are we expecting, I would say broadly, growth back on track would be somewhere like FY22 or the last quarter of FY21. So in the interim period, like immediately for the near terms, next to 6 to 9 months, we believe that growth will continue into the contraction mode. Obviously, the green shoots have started, high frequency indicators have started showing positive trend. But I would say too early to jump the gun on the aspect that we are back on the safe zone and growth is on the uptick. So for the near term, I would say it would remain broadly on an uptrend. But for growth to come back to normalcy, I think we are looking at FY22 first quarter. On the inflation front, I think yes, because there is a lot been a substitute of items on essential goods, and probably crude, cereals, pulses have all shown uptick in prices, and that has led to the trajectory for CPI in the near term looking upward. We are not that worried about this inflation on an overall perspective. We believe that inflation will remain for most part of this year well under the RBI mandate of 4 to 6%. and hence, in fact, in the second half, we might see inflation on the lower trend. And hence, we should not get too worried about the macro environment today. I think on the external side also, currency as well as FX reserves have been significantly huge. And hence, our belief is that macro environment, obviously, but for growth, which has started showing some bit of uptick, macro environment continues to remain strong and intact for India. Onto the reading for policy, I think policy was a status quo. There were a lot of measures being taken across, including additional refinance facilities for NABARD, announcement of some kind of relaxations and restructuring on loans. So overall, it was a balanced policy as markets were not significantly pricing in a rate cut. Hence, actually, market action has also remained quite muted. We believe that obviously, if you look across at the broader macro environment and the cycle, I think RBI has demonstrated a significant move as well as have done a lot of front loading of rate cuts. That doesn't mean it's the end of rate cut cycle, but from here on, aggressive rate cuts looks limited to us.
Okay, understood. Devang, so now I want to get in your opinion of all of this in the context of debt funds. Many a times, of course, the macroeconomic jargons are not understood very well, by retail investors, individual investors. So how do you sort of thread all of this information together to understand their impact on debt funds?
So, see, our belief is that what will RBI do? RBI will continue with his, I would say, accommodative stance for a longer point of time. Analyzing the macro, I think it is too early to jump the gun for the central banker to get worried about inflation because growth is still weak. We need to have growth back to normalcy before we see any kind of large unwinding actions from RBI. Hence, we believe that for most part of this year, rates would be on a stable rate environment. We will not see, neither we will see aggressive rate cuts, nor we will see huge rate hikes from current levels. Our belief is a small rate cut in the second half, and then post that stable rates for almost 6 to 12 months is what we can expect from the central bank. In that backdrop of broadly growth stabilizing, inflation not too much of a worry immediately, and a stable rate environment, from a debt fund perspective, we are advising clients to stay in short to medium term strategies. Yes, uncertainties are still there on the growth outlook, but because we have started seeing some kind of green shoots in the data points and high frequency indicators have started showing uptick, we have started advising clients who, from a medium-term perspective, to start allocating some portion to AA assets also. Obviously, it would be in a phased manner. We are not trying to put it across that that you should immediately be invested into lower rated assets. But I would say that on a medium-term perspective today, looking at the interest rate cycle, stable rate environment, trust of liquidity, entire credit problem being well managed by the central banker, we believe that a smaller allocation to AA assets can be added to your portfolio. So short to medium term funds with a tint of AA assets is what we are advising clients at this point of time.
Okay, Devang, so I get your point. You're recommending short and medium term funds. But like you mentioned, because the economy may take a little time to recover, we perhaps will not see a recovery until FY22. Like you mentioned, interest rates will either stay at roughly about 4% or they may see a roughly 25 bips dip, in the second half, or 25 to 50 basis points dip. Either which ways, it does not bode well for long duration fund holders who basically, obviously, like the name suggests, want to hold the fund for maybe more than 3 years to 5 years. So any advice that you are giving them?
See, our view is that broadly we are at the end of the rate cut cycle. Now, as the inflation has shown a bit of uptick, similarly, I think green shoots have started on the growth front. So RBI would not be under too much of pressure to deliver aggressive rate cuts. Markets I think can look at around another 25 or 50 odd basis of rate cuts from year on, which can lead to the 10-year GSEC bond yields, which are currently trading at around 580 odd levels, can move down to 5.5. So 20-30 basis of additional rally is possible on the long bonds, but beyond that, I think we will not see huge capital appreciation or capital gains from long bonds. Let us also keep in mind that long bonds over the last 18-24 months have come down from 8% to all the way to 5.8% now. So broadly, we have seen a 200 basis kind of a movement in long bonds in the last 2 years. So we believe that 25-30 basis from year on, we can see capital gains, but broadly, from long funds perspective, investors should not expect too much of capital gains from year on.
Okay. The one category within the entire debt fund basket that we've seen a lot of, momentum in, we've seen a lot of flows as well come in, is gilt funds. As the name suggests, it's basically invested in government-backed securities. And right now, amidst all of this uncertainty, investors want something which will give them close to zero credit risk, right? Which government-backed securities will always give you, and hence gilt funds. In fact, in the last 2-3 years, gilt funds have given great returns as well. So what's your opinion on those? Or do you believe that if someone has gilt funds, maybe those people as well could perhaps move away and look at, like you mentioned, short-term, medium-term, AA bonds?
So I would say that in the next 3 months or so, investors should start moving out from long gilt funds to broadly short to medium-term categories with, as I told you, with some allocation to well-diversified AA portfolio. So broadly, 80-20 mix, 80% being AAA, 20-odd% into AA assets, well-diversified portfolio, I think on a short to medium-term perspective is the best advice. Slowly and steadily, I think in the next 3 months, investors can start looking at exiting on from the long gilt funds.
Okay. We've noticed a very interesting trend that has come by in this April to June quarter, and that is the RBI noticing the flow of fresh fixed deposits doubling from the corresponding quarter. So while in the corresponding quarter, new FDs were roughly at about 3 lakh crore rupees, this quarter, April to June 2020, it was at 6 lakh crore rupees. And this despite the fact that obviously fixed deposit rates have plummeted quite considerably. It's this whole risk-averse sentiment, right? People want an investment product now that will give them guaranteed return, or at least that I know that I am going to get this return, even if it's low, even if it's 5% or 6%. But should investors, perhaps now look over at debt funds, that could offer better rates, in your opinion?
See, I would put across a couple of things here. So from a perspective on investment in debt funds, what we believe is that investors should have some allocation to invest as a particular percentage of their savings and net worth into debt funds at all point of times. I think short to medium term category is a very, very good safe bet over a long term period for investors who are trying to beat tax-free kind of returns, tax-free product kind of returns. It's an alternative to tax-free products. From a perspective on your inflation theme, I still believe that yes, we should not get too worried about the near-term rise in inflation. The medium-term inflation continues to remain still on a downward bias. Our understanding is that the whole FY21 inflation would be close to 3.5% to 4%. So probably we are not still into a negative real interest rate environment. We are still into a positive interest rate real environment only. And debt funds should have an allocation at all point of time. The percentage of allocations, yes, depending on the macro environment, can change. On generally when you are positive on growth and positive on an overall macro environment, you can have a slightly higher allocation towards the riskier asset classes, which is riskier and higher volatile asset classes, which is equity and other assets. When it is vice versa, which is a bad growth or a bad macro environment, you could have a higher allocation to debt. Because we are moving towards a cycle which shows improvement in a growth phase, I think incrementally you should continue to have a debt allocation, but the debt allocation can be slightly lower.
Okay. So all in all, just to summarize our conversation, how should a retail investor split his or her monies across the variety of debt funds, the various umbrella of debt funds? I know you already mentioned that short and medium term funds, are the way to go. But I'm sure that does not mean, you put all of your money that you've allocated for the fixed income side of your portfolio into medium and, short term debt funds. So how would you recommend they split it across all of these funds?
So, see, how would I put it across is that it depends on the investment horizon of the investor. If the investment horizon is less than 1 year, I think low duration and ultra short term categories are the best advice for investors at this point of time. Similarly, if the investment horizon is greater than 1 year and probably more towards 1 to 3 year investment horizon, I think short to medium term funds, well diversified, some allocation to AA assets is the best advice to investors. For investors who are looking at a strategy where they want to be a permanent investor in fixed income and who are looking at longer term interest rate calls and interest rate views, I think for those sort of investors, long term dynamic bond funds also make a lot of sense. So these are depending on the investor horizon and his investment period. Up to 1 year ultra and low duration categories, 1 to 3 year short to medium term, and an investor who just wants to stay invested in debt funds, I think dynamic bond funds also make a lot of sense.
Okay, excellent. Devang, thank you so much for joining us today on the Money Show and, sort of explaining, how investors should read into the RBI announcement, the RBI's outlook as well on the future interest rates, future inflation, so on and so forth. Of course, Devang believes that maybe inflation will stay a little low, which is great, for consumers like you and me. He does say that maybe you could move some money into short and medium term funds, could move into some AA funds as well, which are definitely lower, a notch lower than, the top quality that's AAA rated. And yes, if you have a small 1 year time horizon, then short duration categories. If you have a 1 to 3 year time horizon, then medium term funds or AA funds. And finally, if you're a long term investor, 5 years, etc., then a long term dynamic bond fund is what Devang Shah is recommending across the different categories of debt funds that are available.